The U.S. stock market is on fire. Record highs, trillion-dollar valuations, and soaring investor optimism, all fueled by one word: AI. But behind the euphoria, there's a growing question. How much of this boom is real innovation, and how much is hype? Let's start with the numbers. The S&P 500 has surged this year, and the driving force isn't broad economic growth. It's a handful of AI-linked giants. NVIDIA, Microsoft, and Apple have powered more than half of the market's gains. NVIDIA's stock is up over 200% since early last year as demand for AI chips explodes. Microsoft's valuation has skyrocketed thanks to its OpenAI partnership and new AI tools. Everywhere you look, companies are racing to show investors they're part of the AI revolution. But here's the problem. Profits haven't caught up. AI investment is booming, but earnings aren't. Many companies are promising massive productivity gains from AI, yet few have tangible results to show. It's a pattern we've seen before. Remember the dot-com bubble? Investors then believed the internet would change everything, and it did, but valuations ran far ahead of actual earnings. Today, AI risks following that same trajectory. Let's break it down. The hype is powerful. AI is being sold as the ultimate growth catalyst, capable of transforming every industry. Wall Street analysts are projecting trillions in future economic value. Every company, from banks to grocery chains, is trying to sprinkle AI-powered into their messaging. That optimism fuels buying frenzies, especially among retail traders who don't want to miss the next big thing. But the reality? Most firms are still in testing mode. AI models are expensive to build, energy-hungry to run, and tricky to scale. Generative AI tools like ChatGPT or Gemini are impressive, but they're not yet generating consistent profits. The cost of AI infrastructure, data centers, chips, and cloud services is eating into margins. Microsoft and Google are spending tens of billions each quarter just to stay ahead. Some economists call this a capital intensity trap. Companies are investing heavily in AI infrastructure, but the return on that investment may take years. In other words, the growth story might be real, but it's early. There's also the issue of concentration risk. The top 7 tech firms now make up nearly a third of the S&P 500's entire value. That's not diversification, that's dependency. If enthusiasm around AI cools or earnings disappoint, the pullback could shake the whole market. However, it's not all smoke and mirrors. AI is delivering real value in certain industries. In logistics, predictive algorithms are cutting costs and improving delivery times. In finance, AI is detecting fraud faster than ever. In healthcare, it's speeding up drug discovery and diagnostics. The difference lies in execution. Companies that use AI to enhance core operations rather than just branding are the ones truly benefiting. But timing is everything. Investors might be pricing in a decade of progress up front. Real AI-driven productivity gains will unfold gradually, similar to how the internet reshaped the economy over time. Early winners will be chip makers and cloud providers, the infrastructure layer of this new digital economy. The second wave, software and service providers, will thrive later once adoption becomes mainstream. So, are we in a bubble? Not quite, but the froth is there. The market reacts to AI headlines the way it once reacted to dot-com buzzwords. A single press release mentioning AI can send a company's stock soaring. That's not sustainable. Eventually, markets demand results, earnings, efficiency, and real-world impact. When that moment comes, some names will crash while others cement themselves as true leaders. The ripple effects go beyond Wall Street. The AI narrative is shaping how companies behave. CEOs feel pressure to showcase AI initiatives in every earnings call. Even firms that barely use AI are rebranding to fit the trend. Traditional industries are doing it too. Automakers, retailers, and even utilities are tagging AI-powered to products just to attract attention. The market rewards perception as much as performance. This hype cycle also distorts investment flow. Capital is being pulled from slower, traditional sectors into tech-heavy funds. Pension funds, mutual funds, and individual traders are concentrating their portfolios in AI-driven companies. That kind of imbalance can create systemic risk if the trend reverses. Still, it's undeniable. AI is a technological revolution. The U.S. is establishing itself as the global center of AI innovation. Venture capital is flowing again. Startups are forming at record pace. Universities are launching AI-focused programs, and entire industries are restructuring around automation and data. But let's stay grounded. Every major technology wave, railroads, electricity, the internet, started with mania. First comes excitement, then speculation, then correction. I will follow the same path. The hype will fade, weak companies will vanish, and the strongest will build the foundation for the next decade of growth. So yes, AI is real. The potential is enormous, but the stock market is treating it like a miracle drug. Instant, universal, and risk-free. The truth is, AI's benefits will take time, patience, and smart execution to realize. In this gold rush, most investors are chasing the glitter. But history reminds us, the ones who profit most aren't the miners. They're the ones selling the shovels. And in today's AI rush, those shovels are chips, servers, and energy infrastructure. The rest? It's still just speculation, until the numbers prove otherwise. Because at the end of the day, Wall Street isn't betting on balance sheets anymore, it's betting on algorithms. And the question that remains is simple. When the hype fades, will the data still deliver?